This is the S&P 500. A lot of people have asked me, do I think the market will continue to drop? Well, I'm here to tell you, yes. Yes, I do think the market will continue to drop. There's just way too much uncertainty out there. With inflation, global supply chain issues, the midterm elections coming up, rising interest rates, and now we're seeing companies slash future projections, and many companies are going down 10% or more in just one day. Although many are now protesting the stock market, this is actually the best time to be buying, because according to research, throughout history, periods of low returns have been followed by periods of higher returns. While nobody knows what tomorrow will bring, I can almost guarantee the stock market will be higher in the long term, and those that buy and hold today will be the future millionaires in the long run. Let's take a look at 3 stocks that are helping investors create that generational wealth. Stock number 1, invest in world domination, BlackRock. BlackRock might be a controversial company because it is slowly taking over the world. But one thing you cannot deny about world domination is that it's a profitable business. BlackRock is an investment and assets management firm. They help other people manage their money. Because let's face it, most people should not be within a 10-foot pole of the stock market. Whether this is through advisory services, fixed income, alternate investments, or portfolio management, BlackRock has over $10 trillion in assets under management. BlackRock charges fees for all the money they manage, and they collect money whether the investments actually do good or bad. It's sort of like those financial YouTubers who have been pumping garbage all these years and now are finally getting exposed. BlackRock has continued to grow its revenues every year, bringing in just under $20 billion this past year. And even though BlackRock stock is down about 32% year to date, its assets under management is actually up 6% year over year. Meaning even in a bad market, the company continues to see people pouring in money. They probably know the golden rule of investing, and that is to be greedy when others are fearful. All that extra income coming in also means that BlackRock is raising that dividend. Their payout ratio is just 40% of their earnings, and they now boast an amazing starting dividend yield of over 3.2% for a blue chip company. BlackRock has also raised their dividend for 14 straight years, and they also continued to pay out dividends during the 2008 recession, though they did not increase their dividend that year. I envision BlackRock the same way I envision the US debt. It's just going to continue to go up. BlackRock trades well below its 200-day moving average of $824. This company is a steal at these prices, and that's why I currently own just under $2,000 in equity and get paid almost $60 every year in dividends for doing absolutely nothing. Make sure you've hit that like button before we get into the next company. Stock number 2, the big red dot, Target. No need to explain what Target does. They are currently the second largest discount chain in the US. Target feels like it can be found within miles of any town. Target's stock price and revenues keep rising, reaching over $100 billion for the first time ever this year. Those worried about the Amazon effect need to factor in that Target continues to grow as a business. And in my experience, they often have better quality, they're often cheaper or about the same price, and they give free shipping without pestering you about Amazon Prime or how great a Kindle is. Seriously, Amazon, if we wanted a Kindle by now, we would have bought a Kindle. Target just dropped 25% in one day after announcing earnings. The company got hit big with supply chain troubles, eating into their profits. Gas is also like $10 a gallon, so that means more transportation costs for Target. As we gear up for a recession, people tend not to spend as much on discretionary items. Target also had lowered its guidance, but it still expects a single-digit raise. It should be noted that other retailers across the board are getting slammed. Year to date, Walmart is down 14%, Amazon nearly 40%, Costco is down over 20%. This decline now means that we can get a starting yield of over 2.3% for Target stock. This is a dividend king that has raised its dividend for 51 straight years and has a payout ratio of just 27%. Target has a loyal customer base, and once we're out of this not yet started recession, I expect people to run to shop at Target again just like investors will hustle to buy this next stock. Stock number 3. At least it's no longer run by Billy Gates. Microsoft. Talk about a company with monster revenue growth. Microsoft exploded to just under $200 billion in revenue this past year. This is a company that could have easily made an investor a millionaire by just owning it these past 10 years, as they've returned 27% annualized in the past decade. Microsoft, of course, sells computers, cloud systems, and services. They sell software. Its monthly subscription services model in Microsoft Office is used at basically every work computer out there. Microsoft acquired the video game company Activision Blizzard for nearly $70 billion, and once that deal closes, that will only add to the juggernaut that is Microsoft Gaming. Microsoft, much like every other tech company, is down over 20% year to date. This is actually a chance to get a blue chip company worth nearly $2 trillion at a steep discount. Microsoft is trading far below its 200-day moving average of $303. Now, Microsoft might not be a huge dividend payer at just under 1%, but they've been growing that dividend for the past 18 years as their share price just continues to go up. And the company is planning on buying back $60 billion worth of shares as they announced that last September. So I would expect more big dividend increases as they definitely have the money to do so. Microsoft has a buy rating from 30 analysts, and none of them believe that this company is a sell. With a $354 price target, there could be as much as a 35% upside with this growth machine. I currently own 14.7 shares of Microsoft for just under $4,000 in equity. And in turn, Microsoft sends me a check of $36.35 for doing absolutely nothing. True passive income right here. So let me know what you think of these stocks in the comments below. As these videos do take a lot of time for me to research and edit, make sure you leave a like for the algorithm before you go, as that really helps out this small time channel. Remember, my videos are always found in podcast form under the Collect Cash podcast name, and I will buy, stash, and collect cash you later.